ignorance of those things. And they're so far afield that I don't understand how anybody thinks that's tolerable.
Right.
And so for every student, and it's very common, I don't know that I have a class ever anymore that doesn't have one or more people in it that face that hurdle in their application, because it's so common. You know, from whatever, child support to a drug possession to whatever. I mean, it's extremely common that somebody has a felony somewhere in the country on their record. And then so to not know whether you have a chance or don't have a chance, it's just rude and, you know, inconsiderate. It's just,
exactly.
it's just, you know, but they don't see it that way. They instead see it that, well, that's not our problem. You know, but, you know, there's nothing written anywhere that says a person makes one publicly known punishable mistake in their life, and therefore they're now no longer afforded a single courtesy of being able to know whether they stand a chance to get in or not get into a particular profession. I think that's completely inexcusable. So whatever anybody else's problems or challenges are or were, I think the way this state, probably every other state in this matter is governed, is worse. So do the best you can. Keep my fingers crossed. Obviously, you know, if you have any trouble along the way, let me know. I'll tell you what little bit I think I know.
I came up with a game plan. I'm going to get letters of recommendation from past clients, and when I submit that paperwork after I pass the test, I'm going to also send in my Better Business Bureau certificates of complaint-free for 4 years consecutively.
Yeah, that makes sense, because that's, you know, if somebody does have a, you know, burr on their saddle, then maybe that would be enough to be able to demonstrate. Because, you know, you don't want to get to the point where you have to go in for a hearing. Right? You'd rather have them just do a manual review and say,
right.
Okay, that's it, stamp, good, you're good to go. Did they tell you even how long that takes?
Nope.
I think it's...
I was going to ask you that question if you knew, because,
no, because
the lady was pretty evasive. She's like, well, I can show you this document, and I printed the document, and I read the document, and I'm like, I'm wasting my time with this document because it says it's an opinion, but this opinion has no validity to it until after you take the test.
Right.
And so it's like, all right, I'm not going to waste my time there. I'm just going to put all these other paperworks together and then send it all in. And if it works, it works. If not,
yeah, well, if it doesn't work, what ends up happening there is then you do go through the appeal process, or not through appeal process, but then you would go through a hearing process, basically what happens. Most students that I see, they get approved, and it just takes, you know, 4 to 6 weeks for that process to happen. And what you lose is you lose that ability to work under that 45-day sponsor card early on. So you might lose, you know, a couple, 3 months or whatever, worst case.
right.
The very worst cases that I mentioned in class last time were those cases where, you know, they decided they were going to actually have a hearing, and then it takes them months just to even find the meeting time to coordinate it, so you're kind of flapping in the breeze for a long time. And then, like I say, the student that I had before, who I would, you know, I would let him have a license in a heartbeat, you know, he's gone through that process twice, and they can't give him any relative reason. And the other challenge, if you do get into that very deep, and I wouldn't worry about this at this point, is that very few attorneys know what to do after you go through the regulatory process. So if you do decide to go very far and it becomes an issue again, let me know, because there's only 1 or 2 attorneys in the entire state that probably have any idea what to do with IDFPR. Because I think with IDFPR, it turns on personalities. As the personnel and the staff changes, what you get in that situation will
Well,
change.
that's the feel I got when I read that paper, because
Yeah.
the person that's going to give the opinion might not be the same person that's going to take a look at your paperwork when it's sent in.
Right, exactly. All right, so tonight we're going to start finance. We'll get back to a rare 2 chapters in a row that actually have a lot to do with one another, tonight and Thursday night. Questions about anything in financing before we get started tonight? All right, so just some terms. I mean, obviously this is all in the book, but just, you know, in case you get test questions in terms of mortgagee, mortgagor. Mortgagee is the lender, and the mortgagor is the borrower. And as I mentioned way back at the beginning of the course when we did chapter 2, you know, this is one of those places where we have plain English language backwards from the reality, right? So borrowers actually give, not get the mortgage. So when you go to the lender and say, I'm here to get a mortgage, You mean you're there to get a mortgage loan, is what you really mean. And that adding that word loan makes all the difference, because a mortgage is a promise from the borrower to the lender. Let's just talk real briefly about the basic idea of how this works. So outside of mortgage financing and maybe cars and that sort of thing, for the most part, if you were looking to purchase something but didn't have the money, you would just say, oh, I can't afford it, and you would move on, and you'd go along towards saving it or making do without it. But with housing in particular, that's not at all what we do. Very few of us are able to pay cash. It was the norm 80 years ago, literally, but it's not, hasn't been since the creation of the FHA in the middle of the Depression, or that Depression era period. But it used to be the norm was to put down at least 50% or pay cash back when houses sold for $2,500. So now, obviously, that's clearly not the case. We have a long-established practice of going fairly high in debt on our property. So basically what happens is we go to a lender and we say, look, Mr. or Ms. Lender, there's this giant wooden box that I'd really, really love to own, but I can't afford it, so I'll make you a deal. You give me the money that I need to buy the giant wooden box, and I'll pay you back with interest over time and give you the right that if I don't make those principal and interest payments, you can take away the giant wooden box. The giant wooden box, of course, is the house, and the promise that the lender can take away the box, your house, is the mortgage. So that's what the mortgage is. The mortgage is your promise to the lender, the borrower's promise to the lender, that they can take the property that you've collateralized. And typically, we're talking about a house, but it could be any real property. Okay. Back in chapter 10, we talked about different types of liens. As we mentioned, the mortgage is a voluntary lien, right? And then the lender's interest typically is just that, security interest. Lenders don't own the property. As borrowers, we own it, or as we'll see under a deed of trust in a little bit, there could be a third party. But really, title for the most part, at least in Illinois, rests with the buyer. The textbook talks about mortgage theory. I want to make a real plain statement that I disagree. Texas said this for years, that Illinois is an intermediate theory. To me, that's just nonsense. Intermediate's a lien theory state. That's all a lender gets in Illinois is a lien, a security interest. I don't know what the publishers or authors' thinking is in that regard. You know, having taken a graduate real estate finance law class at a well-known law school from one of the members of the board of trustees who is one of the co-founders of a 100 and some odd member law firm downtown Chicago, where all he does is real estate finance, he has the same opinion. So I think I'm right on that. I don't know if you'll get a question on that, but the idea is that, you know, there's basically kind of a broad possible range here, and at the top, you know, the idea under title theory is that the lender would hold title, and like I just mentioned, that's not the case anymore. So I do not believe that there are any title theory states left in the country. In the lien theory state, basically all the lender gets is a security interest, whether it's a trust deed or whether it's a mortgage. Illinois being a state where you're only going to see mortgages, probably, for practical reasons. Again, that's all the lender gets, which makes Illinois at the bottom, or the lien theory. Intermediate theory states are going to be those that, where you end up with a deed of trust, and the lender doesn't hold title, but neither does the borrower. It's held by a trustee who's holding kind of legal title, even though the buyer has equitable title, as we talked about before. Again, I don't know that you'll get a test question on that here, but you might at the state exam, maybe one. Hopefully there's nothing about Illinois being an intermediate theory state, because again, I think as a professional, I think that's just categorically incorrect. All right, so again, under terms, creditor is the lender, right? The creditor is the person to whom money is owed. The debtor is the person who owes the debt. Collateral is the asset that you pledge. So in our case here, it's the real estate. Again, typically the house. So if you put up your car for a car loan or a title loan or whatever, that's going to be the collateral. The various instruments that we're going to talk about tonight, mostly we're going to focus on the promissory note and the mortgage, and the two of those working together in tandem. But we'll also touch on deeds of trust, though I will tell you now I will not ask you a trust deed question. because deeds of trust are typically not used in Illinois. If a deed of trust is used in Illinois, it's treated like a mortgage anyway. They were. My first house loan, I think, was a deed of trust. That was back in 1980. Federal law changed, or maybe it was state law changed, whatever it was, in about 1983, as I recall. And so mortgages in Illinois became the predominant lending instrument. This term hypothecation is just the process of putting up the collateral. Again, I don't know if you get a test question on that. In practice, I've never heard the term, well, I'm going to go hypothecate my house. I've just never heard anybody use that in practical terms. The promissory note, the IOU, the business deal between the parties, typically just called the note, specifies basic things like how much is owed, what the terms are, what the interest rate is, how and when and where it's to be repaid. Technically, we probably can refer to this as the primary evidence of the debt, right? Because this is where all the information is about who owes what. Big thing about the promissory note is it's signed by the borrower, so it's your admission that, okay, I now owe this money. At the end of tonight, we'll come back and talk about the importance of this being a negotiable instrument and the fact that negotiable instruments can only have one original copy. Right? Cash is, this is negotiable instruments, and I have a series of $1 bills here. To make sure it's clear that each one of these is a separate negotiable instrument, the federal government puts serial numbers on them, right? So it's very clear that each one of them is an original, and each one of them can be turned in as an asset value. Well, what happens if you went to the bank and borrowed $200,000 and signed 2 original documents? The bank would then have 2 notes, and as negotiable instruments, that would be a problem because you would owe that debt twice. So we can't do that. So there's only one original of something that's a negotiable instrument, whether it's a stock certificate or a corporate bond or bearer bonds or whatever it might be. Negotiable instruments only have one original copy, and only the holder of that note is entitled to payment. Mortgages are recorded. Promissory notes typically are not. So when you go and check the public record to see what somebody owes on a property, if that's your goal, the only thing you're going to find is the mortgage document, which will specify what the maximum amount of the lien was, in other words, what they borrowed at the very beginning. You will not know when you go to the public record whether that was a 30-year fixed rate loan, a 5-year adjustable. It's just not there because the promissory note doesn't get recorded. And that's probably a good thing today because the promissory note may contain a lot of personal information like social security numbers and other things that have no business in the public record. In today's identity theft world, we have to be a little bit careful about what is in the public record and what is not. By the way, if you find some of your own personal data in the public record, like social security numbers that you don't want there, you can talk to the county recorder of deeds and see if you can get some of that information, if not all of it, removed. They won't pull the documents, but they might, redact or whatever those particular aspects of it. All right. As a negotiable instrument, a note is assignable. So this is what happens when you borrow money from a local bank and they turn around and sell it to somebody else. You're making your payments to Old Second Bank, and then one week you get a letter, and the next thing you know, you're making those payments to America's Servicing Company. I have no idea now who's your lender anymore. Doesn't really make any difference. Contract language, remember, contracts are assignable unless that's prohibited, and you can bet that lenders want their finance instruments to be assignable if they have the right to sell them. We'll talk about more in class Thursday night. This is the norm rather than the exception. The lenders do not hold on to their loans very long at all. A promissory note does not have to be tied to a mortgage or any other any other collateral at all. You can have an unsecured promissory note. Right? I owe you $20, due and payable on the 1st of May 2015. Promissory note. It doesn't have to be tied to any debt. You just come calling and get that money back later. And again, it really works in tandem with the mortgage. You could theoretically have a mortgage without a note, but that would be very unusual, extremely unusual, maybe almost non-existent. But you can easily have, there are all sorts of promissory notes that are not tied to mortgages. All right, within the term of the note, we talked about the fact that there's an interest. So I'd like you to think of interest as the cost to rent the money, right? That's what you're doing. You're borrowing money and you pay the lender for that, right? The lender has a commodity. The lender has a widget. What does it sell? Cash. Whose cash is it selling, by the way?
Yours.
Yeah, in part, all of ours collectively, right? We each put $5,000 into a savings account, and pretty soon there's enough money for somebody to go and take out a home loan and buy an $80,000 house. So, that's the basic idea. So what the lender does is they pay us whatever, 1/10 of 1%, something like that, and they loan the money out at 4. That spread is how they make their money. So interest is part of that. Now, usury is a term you should know. Usury is the idea that some level of interest is illegal or immoral or something. So there are statutes of sorts that limit interest amounts. But beyond just what state statutes do, there are religions that prohibit the payment of interest. Islam is an example. Christianity was an example until 4th or 5th century. The leaders of the church realized how much money that Jewish bankers were able to make by loaning money out. So they changed the rules. The idea being in those religions is that if somebody needs money, you're supposed to help them, not loan it to them and charge them interest and make money on somebody else's deficiency or problem. In today's world, it's hard to imagine the world functioning on that kind of basis anymore, because capital and proper application of capital, including borrowing and repaying, is a lot of what drives our economy, both locally and internationally. So it's hard to imagine a world without that. But it is important to know that you could, in theory, have a client who doesn't have cash to pay for a house and can't borrow the money without going straight to hell in their own minds after they die. So what do you do with a client, a real estate client, who really wants to buy the house and they have the income to qualify, but they can't personally borrow the money? What would some options be? This is just for grins, but this kind of thing happens every once in a while. Well, you could have them set up a company and have the company buy the house. Let their company go to hell instead. Then it doesn't affect them. Well, it's true, right? It's a nuanced difference. Another thing would be to have a participation loan with the lender. This is probably not going to happen today, but it did happen occasionally pre-2005, when lenders could see properties appreciating at 10 to 20% a year. They could make more money in appreciation than they could make on the interest. So the lender would become basically a co-owner of the property, put up the cash, and get an interest at least equivalent to what their interest would have been. But it's not called interest anymore. It's a different kind of business deal, making it technically legal, under those religious laws or views or whatever somebody has. So there are some ways to do that. Seen that done from a distance a couple of times. It's just kind of interesting. Now, Illinois used to have a straight-out usury law. It used to be illegal to loan money in Illinois against real estate above 8%. That was until the late 1970s, early 1980s, when the prime rate of interest hit 21% on 3 distinctly separate occasions. Not like within weeks, but over a period of several years. Rates were ridiculously high in the late 70s, early 80s. Like my first home loan, I thought was a pretty good deal because I only paid, 13.5%. What the heck was the deal? You didn't lock in those days. It's not what happened. I mean, today, it's why locking in your rate when you go to borrow is such a big deal. But I think when we applied, it was going to be like 12.5 or something to that effect. By the time we closed 60 days later, it was 13.5. Now, today, if your interest rate went from 4 at application to 5 by the time you closed, you'd be thinking the sky was falling. But that was kind of normal in those days. You had ridiculous inflation, and started with Gerald Ford and then Carter's administration, and then pretty much ended around the time of Reagan. But Paul Volcker, who's still alive, I think, who was the Fed chair at the time, they had buttons that would say WIN, called Whip Inflation Now. The idea was raise the interest rate so high, nobody would invest or spend much money, which would cause prices to fall and would get price inflation. And it worked, but it was a brutal way to do it, and it was pretty challenging time. So to hear what the Fed concerned about inflation today, some people remember back to the late 70s, early 80s. It was pretty brutal. So when interest rates got to be super high, Illinois banks stopped lending. They said, we can't charge enough points and fees and other kinds of things up front to make it worthwhile. If we have to pay 11% on passbooks, savings, we can't loan money out at 8. We just can't, we can't do that. So in order to fix the roadblock, there was a kind of a horse trade. So the state of Illinois said, we'll allow you to loan money at any amount. If it's secured by real estate, no more usury ceiling for commercial lenders in Illinois. None. But you cannot charge a prepayment penalty on any loans above 8%. So that was the deal, and that's what ended up happening. I think lending ground to a halt for about 6 or 9 months, as I recall. I wasn't trying to borrow at the time, I just remember it was kind of an odd scene. All right, so let's talk about some basic terms. The interest rate you think of as paying on your mortgage loan is what we refer to as the contract interest rate. So when you go to the lender and you take out this 5-year ARM today at 3% or whatever, that's the contract interest rate. When that rate adjusts in 5 years and goes to 3.5 or to 4, that's the new contract interest rate. So that's that, right? And that's one of the ways lenders make money. They make money on the spread between their cost of funds, getting it from us or wherever else they would acquire it, borrowing it from the Fed or whatever it might be, selling stock if they're a publicly traded bank, and what they're able to loan it out at, right? That's how they make money on that spread. So contract interest rate is the face value of the note, but there's other ways for them to make money. Things like loan origination fees and discount points and maybe prepayment penalties. So a loan origination fee is oftentimes couched as the idea that it's sort of covers the cost of originating a loan. A loan officer's commission, a mortgage broker's fee, whatever. It works exactly the same way as discount points, except it's given a different name. Now, from the lender's perspective, this is meant to cover overhead and isn't intended to be treated as interest. But the tax code says differently. The federal tax code says no, loan origination fees and discount points and maybe even prepayment penalties are all income tax deductible for residential borrowers. And that's the kind of test question you might see at the state exam. It's tax deductible. So when you take out a new loan and you pay a loan origination fee, you get to deduct that fee in the year you bought the house. It's calculated on a percentage basis, a half point, quarter point, 1 point, with points meaning the same thing as they do for discount points, but it's not called discount points, it's called a loan origination fee. Now, discount points, which mathematically get calculated the same way, and according to the federal tax code are precisely the same thing, are actually treated differently by lenders. The idea of a discount point to the lender is it is categorically, without question, prepaid interest. Pay us some interest up front and we'll give you a better interest rate. So that's the general idea. You pay discount points to either qualify when you might not otherwise, or to be able to buy down the interest rate in effect, though I wouldn't really use the term buy down in that case, but that's the idea. So when we talk about something like a point, what is a point? Well, 1 point equals 1% of the loan amount. 2 points would be 2%. 2.5 points, 2.5%. And you'll probably get a test question, a math question, where you'll be given a sale price and a loan-to-value ratio and the number of points, and then be asked to calculate how many dollars in discount points are going to be charged. So hold that thought. I think I have more after this. We'll come back to this. All right, so prepayment penalty, or just prepayment in general, but prepayment penalty also, according to the tax code, is just prepaid interest. But instead of paying it at the front end, you're paying it at the back end, when you pay the loan off earlier than it is originally scheduled. Now, let me ask you a question regarding, bear with me a minute here. Yeah, let's just ask you a question regarding prepayment and prepayment penalties. Let's assume that the loan documents, the mortgage and note, are silent to this as to whether there is or is not a prepayment penalty. Doesn't say anything at all about it. Under common law, what do you think the rule is? Does the borrower on a loan where prepayment, either as a penalty or at all, is not addressed in the loan docs, does the borrower have the right to prepay the loan whenever they see fit?
I would say yes.
Okay, so yes, I got some nodding heads. Makes sense? That's absolutely not the case. The opposite is true. This arrangement, this financing arrangement, is a negotiated contract deal between the borrower and the lender. And the lender has bargained for an income stream over a period of time. They're expecting a certain amount of interest, right? And now all of a sudden, that's not going to happen. So it's very important to us as borrowers that we are given the right to prepay in the note or somewhere in the loan docs. And then we have to look and see beyond that, is there a prepayment penalty? This can vary a lot. There aren't many residential programs that are commonly used anymore where there are prepayment penalties. There can be, but in the world of commercial real estate, industrial real estate, where it's used to seeing those kinds of deals, prepayment penalties are almost impossible to avoid. So we'll talk about this in a little bit more detail in just a little bit. We run through all of these things in more detail. Just remember, there's different ways for lenders to make money other than just the contract interest rate. All right.
I got a question.
Yeah.
The loan origination fee, would that be the same thing as closing costs?
It's part of. Closing costs can also be fees that don't tie to the dollar amount of the loan, where an origination fee does. So a lender can charge you what are sometimes referred to as junk fees, but as far as the lender is concerned, it's their cost of doing business. A processing fee, an underwriting fee, flood certification fees, $15 here, $200 there. All of those are closing costs. Your termite inspection, which really has nothing to do with your lender, is also a closing cost. So, and remember, when we're closing a real estate transaction, we're typically actually closing two deals. We're closing the sale, purchase and sale, we're also closing a loan. So closing costs are the bigger item, and loan origination fee would be one item in there, along with discount points as a potential closing cost as part of that. Steve, you also have a question?
On the prepayment penalty, was selling your house, is that penalty induced too?
I'm going to talk about that in just a minute, because sometimes the answer to that is yes, and sometimes the answer to that is no. Depends upon how it's crafted. All right, so let's talk again a little bit more about discount points, just to give you this example. Prepaid interest, typically paid at the loan, not typically, it's paid at the loan closing. Right, so you want to borrow $100,000, that's what you need. You need every penny of $100,000, and the lender's going to charge you a discount point to get that interest rate you want, etc. If it's handled the kind of the normal, old, traditional way, when you go to borrow the $100,000, you won't actually get $100 to buy the house, will you? Because $1,000 of that has to go toward the lender. So when people were running across this problem decades ago, they would say, "Hey, I'm borrowing $100,000 and you're taking $1,000. Now I don't have the $100 anymore." And lenders would say, "No problem. We'll roll it into the loan," which means you don't borrow $100, you borrow $101. So they get their $1,000 point, and then you pay back $101, even though you only got $100. So either way, it's the same thing. And lenders really like this idea of points and fees up front for several reasons, one of which is it greatly improves their yield or the return on their investment being handing you the cash to buy the property you're looking to buy. But it also helps in the case of any potential default, because some of the money is paid in advance. You can't default on this because they take the money back from you right at closing. Right? Whether it's a refinance or a purchase, they take that cash right away. So in the event of a default later on, that's some additional money that they actually collected as income that makes it seem like it was a better idea. So again, lenders like this idea of points and fees paid up front. It's attractive to them. So here's the typical kind of question you might see on my final exam. Again, this is one of your 8 or 9 math questions, something that will read similar to this. There's a $100,000 sale, 20% down payment, or we might say 80% loan to value. 3 discount points are charged by the lender. What's paid in dollars in points at the closing?
2,400.
Yeah. So you take the 100,000, subtract out the 20%, because we don't really care what the sale price was, right? This is a loan cost. So anytime you see discount points, there will be distracting information in the test question typically, and that distracting information seems like it matters because it's a sale amount. But if you apply the 3% to the sale amount, you're already missing the point. No pun intended. 3 points times 80,000, so you take the 20% out of the 100, right? So you've got 3% times 80,000, which gives you a $2,400 discount point payment at closing. And if they were going to roll that money into the loan, you wouldn't borrow 80,000, you'd borrow 82,400, plus any other fees or other things that the lenders are so generously willing to let you roll into the loan. All right, so talking about prepayment penalties now, as I mentioned, this is also considered interest. It's just prepaid ahead of when the lender originally expected to get it, what the lender originally bargained for, but with prepayment being allowed under this kind of arrangement. All right, this is where it's paid off at the final payoff. So if you sell that property or if you refinance it and there's a prepayment penalty, that will get wrapped into that final payoff number that goes to the existing lender. You know, usually say, okay, we're closing today, and today is March 3rd, and it's going to take us 2 weeks for this money to get to the lender, so let's calculate the payoff 2 weeks in the future. We'll include interest per day between now and then, and we'll include the prepayment penalty or whatever as of that date, and that's the amount of money that's taken out of the seller or the refinancer's proceeds. And then if it's an overpayment, that lender will rebate that money within a few weeks. Occasionally, some loan documents will state that if you prepay more than 20–25% of the loan, maybe at all, or in a given year, that also triggers the prepayment penalty. I don't know that you see that today. Most loans today are running through conventional sources and are going to fit into what we're going to talk more about Thursday night as Fannie Mae and Freddie Mac underwriting guidelines. So they're much more consistent and a little more conservative and protective of borrowers. But in the woo-hoo days of pre-2007, when you had money coming from all kinds of places, and we might get back to that, or if you are talking about non-residential, so particularly again commercial and industrial real estate borrowings, then you will see that, or you can see that kind of language in the loan docs, where if you pay down more than a certain amount, that will trigger a prepayment penalty. Not on the whole amount, but on whatever you've prepaid beyond the limit. Again, remember, the lender is bargaining for a particular rate of interest, and that's what they're hoping for, and they want to discourage you from refinancing. What's up with the lender? Why does the lender care if you refinance your own loan or your own property?
You only do it if you get a lower interest rate.
And if you're getting a lower interest rate, what about the money they've just gotten back? They now have to loan it out at that same lower interest rate. So what's great for us, all right, I'm going to save money, is bad for a lender because their spread just went down. Even if you reborrow from them, refinance with them and pay them some fees, their money is now at work at a lower rate of interest than it was before you refinanced. So again, the idea of prepayment penalties in part is to discourage constant reborrowing. Again, prepayment penalty in the year that you pay it, because you're paying off that loan, that prepayment penalty is tax deductible if it's on your residential deal. It's a business expense if it's anything else. So again, it is a tax deduction. Now this gets to the heart of the question that Steve was just asking. If you sell rather than refinance, does that trigger the prepaying? I've heard this terminology used, though not frequently. So a hard prepay is a prepayment penalty where it doesn't matter why. You sell or you refinance, it triggers the prepayment penalty. A soft prepay is where a lender gives you the right to prepay without penalty if you sell, but not if you refinance. So again, just know your loan documents. Don't make any assumptions. I don't think of the typical Fannie or Freddie loan today on a fixed rate conventional loan, you're going to see a prepayment penalty on residential, but I don't even know that. I haven't had to borrow money personally for a residential loan for about 11 years, 10 years, something like that. So I haven't read one recently. But again, in commercial real estate, I see this kind of thing all the time. In fact, I've sometimes negotiated different deals. one set of prepayment penalties if we sell and a different set of prepayment penalties if we refinance. So I might say to a lender, look, I don't want to be in a situation in 3 years where I can't sell this property and get the money to the investors because we don't want to pay your high fee. So then we negotiate, as we're negotiating the loan, a lower prepayment penalty if it's in case of a sale, or a partial waiver or whatever. Some prepayment penalties aren't fixed amounts, they change over time. So let's take a commercial balloon loan. If you haven't read chapter 16 for Thursday night, you may not be familiar with the idea of what a balloon loan is, but it's a loan that matures long before it's really due to pay off by payment schedule. So the idea of a balloon, say a 5-year balloon, is that in 5 years the entire loan is due and payable. This is common for commercial real estate. So it's also common to see something like a 5, 4, 3, 2, 1 prepayment penalty. Prepay it in the first year, it's 5%. Second year, 4%. Third year, 3%. Fourth year, 2%. Last year, if you pay it early, it's only a 1% prepay. So you can have those. I've seen 3, 2, 1s. I've seen 5, 3, 1, 1, 0, whatever. You can negotiate that. In other words, if somebody tells you it's a fixed, prepayment penalty, recognizing now that the lender is looking to earn a certain amount of interest to cover their costs of doing business and generate a profit, well, once they've had that loan for a while, they're making enough money, so they should be willing eventually to get rid of or reduce that prepayment penalty. Questions about prepayment penalties here at all? Virgil?
Do all loans have prepayment penalties?
No. No, in fact, for residential, I would say typically they probably do not. Is that, yeah,
Probably don't.
yeah, today. And again, that's because today, we're a little bit more consumer protective. We've got the Consumer Financial Protection Bureau and other, agencies that are now looking out for consumers. When you had a lot of subprime loans and loans that weren't going through Fannie Mae and Freddie Mac up through 2007, a lot of those had prepayment penalties. And that was one of the, somebody couldn't get out of their loan no matter what they did. Because even if they could refinance, they were going to have to pay something, a big chunk to their previous lender to get out from underneath it. So today, I would say most residential, most residential loans today do not have them.
I mean, this was years ago.
Yeah, yeah. But I see them a lot in my world. So it kind of depends upon the loan and where the money's really coming from.
Okay, thanks.
Other questions about that at all? All right, then I just wanted to point out that it is possible, again, we're talking about a commercial or industrial loan here, to enter into a loan that actually has what's called a lockout. A lockout categorically forbids the borrower from paying off the loan early. You can't do it. There's no mechanism for paying. Not a prepayment penalty. You're not permitted. Secondary mortgage market loans for commercial and industrial property that have really good interest rates and maybe a 10-year balloon period or something like that, where the lender needs to earn that full amount of interest to have made it worth them loaning the money in the first place, based upon the assumptions, their projections, etc., could have a lockout. So then what do you do if you need to sell the property in 5 years? The lender has to approve the buyer, and the buyer has to assume or take over the existing loan. And that lender will then charge a fee, 1 point, 2 points, whatever it is, for assigning that and accepting the assignment of that loan, or the delegation of the duty of the loan, really. So just want you to be aware that that kind of thing exists. Again, for those of you who go on and practice residential real estate or residential investors, you'll probably never see a lockout. If you borrow money from a local bank to do your, local, buy a strip center for $1.5 million, you won't see a lockout. But if you go out into the secondary mortgage market to get $20 million to develop an office complex, then you might see a lockout, or to purchase a hotel building or something, then you might see that. Okay? I doubt you get tested on that. I don't think there's anything like that at the state exam. All right, so let's move on then and talk about provisions of the security instruments. And here, let's talk just very briefly about the deed of trust. Again, no questions from me on a deed of trust, but this is one of those areas where you can see questions at the state exam on deeds of trust in the national portion of the state exam. You won't see it in the Illinois portion because we don't use them here. By law, a deed of trust in Illinois will be treated like a mortgage. The idea is that all financing instruments are two-party instruments, borrower, lender in Illinois. That's it. The deed of trust is a three-party instrument. The borrower is the trustor. A neutral third party, perhaps a title insurance company, serves as the trustee. And the lender is the beneficiary. What this allows is that in the case of a default by the trustor or borrower, the beneficiary, who's now not receiving their beneficial interest, their rights, their payments, can petition the trustee to convey title. So back to the beginning of class when I was talking about title theory versus lien theory, see in Illinois, the lender has a security interest. They have a mortgage lien on the property. That's their interest. But in a different state, such as California perhaps, where you might see trust deeds or deeds of trust fairly commonly, you have three parties involved. And legal title rests with the trustee. Equitable title, equitable rights are still in the hands of the trustor, the borrower, so you still really own your own house. It's not owned by the bank. Again, no states, in a borrowing scenario, in no state, as far as I know, left in the U.S., is the title holder actually the lender. But it might be as simple as the lender sending the right kind of letter to the trustee, swearing that the borrower is in default, and in those cases, the trustee may simply be able to convey title. And that could happen within a couple of months after you're in default.
What's the benefit to a lender with the deed of trust, getting the 3 tiers rather than just the 2-party?
It's just, I just explained, it's that ability to foreclose without having to go to court and being able to be able to rest title and then kind of put the pressure back on us as borrowers to reclaim that. So that's really it. And Illinois being, in this case, more borrower-friendly than lender-friendly, doesn't see the need for that anymore. And this is really what it comes down to, how a state decides to balance the interest of its business, banking community, and its individual taxpayers. You could argue either way is better, depending upon what your perspective is and what your experience is. Other than that, there's really not a lot of point. It adds some complexity. I suppose there's a little bit of money in it for the title companies who are getting paid $300 a year. Again, I've only owned property in Illinois, so I've never actually, I say that, I can't say I've never owned property under deed of trust. I did, my first house, but I don't remember anything about it.
Would it be more expensive on the borrower's end?
Well, probably, like I say, somebody's paying the trustee for that fee. Now, maybe when it was done in Illinois 30-some years ago, maybe the lender could be the trustee also, right? We've seen cases of multiple parties being the same. Today, I don't think that's allowed anywhere. So I'm not quite sure, what all the mechanics are, but my assumption is, yeah, it's got to be a few $100s more. So do you pay an 1/8% more in interest and that covers it? Or is there a fee you pay at closing? Or I don't know how that's going to be. Does the borrower pay it? Probably paid by the lender. I don't really know. I don't know the mechanics of that one. Go ahead.
Do you know what the difference between the deed of trust is and an executor's deed?
Well, an executor's deed, right, would be a deed from the executor of an estate,
Okay.
which isn't necessarily having anything to do with borrowing. This is, the reason we have a deed of trust here for a loan is because there's a conveyance. If you paid cash for the property, then you would own it in severalty. Now you go to a lender that's in a state where deeds of trust are used, and now you're going to have to convey legal title to the trustee. So you do that by way of a deed, hence the term deed of trust.
Okay.
In Illinois, where you buy the property, whether you pay cash or whatever, you are and you remain both the legal and equitable title holder, and all the lender has is a security interest. That's the big difference here. All right, whether you're a mortgagor, the borrower, or the trustor, again, it's the borrower, you have certain obligations. These are our obligations as borrowers. First one should be pretty obvious. Right? The lender is expecting to get repaid. And the lender's looking to get not only their principal back so they can reinvest that, so, right, when we make payments, we'll look at this again more Thursday night, but when the lender is making, or excuse me, when we're making payments to the lender, we're paying typically both principal and interest. So as the lender gets the principal back, they can do something else with it, put it to work to make money, loan it to somebody else for something else, their house, cars, whatever. And they get their interest, which is, again, what they're using to pay interest on the money that they've borrowed in some fashion and to generate profits and overhead, etc. So that's pretty fundamental, pretty important. Why is one of the duties of the borrower that you have to pay real estate taxes? What's the one thing that would really scare a lender? A first mortgage lender is not really in first place, right?
No, he is.
So it will say in the loan documents, you have the obligation to pay the real estate taxes, and if you do not pay them, we, the lender, have the right to pay them on your behalf and charge you accordingly. Hence, lenders sometimes redeeming the delinquent taxes after the tax sale. That's one way for the lender to lose their interest in the property totally, is to lose it to the taxman or the tax buyer. Maintain adequate insurance. Why does the lender care if your house is insured or insured to a specific level?
Because if it burns up or blows up, there's not gonna be anything there for them to collect on.
It's helpful if we can see this through the lender's eyes, right? Who's put up most of the money? The lender has, and they don't want to lose the giant wooden box. That's worth more to them than it is to you or to me. So they will require that. In fact, when you go to take out a loan, when you apply, you should get a sheet from the lender which says these are the insurance requirements, and that's what the borrower or the home buyer can take to their insurance agent and say, this is what I need for insurance. And you know that because that's what the lender is requiring. And if you don't have that, you may not be able to close because the lender is going to be looking for that at the closing date. The lender requires us to keep the property in good condition. So your gutter's falling off, your garage door needs to be replaced, one of the sinks is stopped up. Seriously, why does your lender care about that? What's the worst place for a lender to be? Or what is it that they're trying to avoid? Yeah, well, they don't want to take the property back, right? Studies have shown that lenders lose about 40 cents out of every dollar when a property goes into default like that. And they end up seizing it. The losses are enormous. It isn't just the loss of the original principal, it's the loss of the ability to collect interest during that whole time frame, plus legal fees, court costs, etc. And if they do take it back, what they don't want is a place that's in bad repair. Because they're not in the business of going in and fixing up and remodeling houses to put them back on the market and sell to the public. In fact, as the whole foreclosure crisis, or whatever you want to call it, unfolded, banks were faced with changing the way in which they had normally handled distressed properties. The norm for lenders was to take the property back and sell it in whatever god-awful condition it was in, just get it off their books. And when they had one or two here or there, that was okay. But when they've been taking them back by the tens of thousands, millions nationally, collectively, property management companies and real estate brokers convinced them they were fools not to get these houses in move-in ready condition, or at least give the appearance of being in move-in ready condition. So many lenders and loan guarantors, such as Fannie Mae and Freddie Mac, have made a point of investing money into these properties to get them freshly painted, newly carpeted. They won't go in and do things like refinish hardwood floors or other things unless it's absolutely necessary, but to get the house so that it shows reasonably well. So again, if the property isn't maintained in good condition, that it impacts the lender. It's always to them, what if? What happens if we take this property back? That has to be in their view, in their vision, what happens to us if. So how does a lender even know? How does a lender know if your house is not in good condition? Well, they may not. But from time to time, lenders will dispatch either brokers or appraisers to do what's known as a BPO, which is a broker price opinion, or in the case of an appraiser, a drive-by appraisal. Either way, it's a fairly quick and dirty valuation of the property that includes exterior photographs. It is perfectly legal to stand in the right-of-way, which would include the sidewalk in front of the average house, and take photographs of that property, regardless of whose it is or whatever. So as a broker, you could, sit in your car at the curb, or you can get up, you can walk up to the sidewalk, and you can take a picture from whatever angle you can get it at. You can see stuff now from Google Maps if you're looking for, is the roof discolored or whatever. There's some kind of a satellite picture that's been taken at some point. You can take pictures down the street either way, which is common for appraisers or full market analyses, to give a sense to the lender what's the value of the neighborhood look like? Does the neighborhood look like it's in good shape or not in good shape? And it's like, this is kind of a kind of statistical sampling. Like when you get a phone call from Gallup or Harris polls right before the election, they want to know who you're going to vote for, and they only talk to you and 400 other people, and they predict the entire outcome of the presidential election or the gubernatorial race or whatever. If they get the right pooling of people, that's enough to be statistically accurate enough to predict the outcome. The same thing is true here. If the lenders get a sense within an area or within a loan portfolio that they look good, then they can rest assured that those loans or those properties are pretty much good. But within a particular area, if the properties are consistently coming back not in good repair, that's an indication to them that they may have a problem with that entire loan portfolio or many properties in that area or in that community or in that neighborhood or whatever it might be. We'll talk a little bit more about BPOs in chapter 19. It's something you can do a fair amount of when you get licensed. If you want to make a little extra money, not a lot. You pay like 80 or 100 bucks to do them, but you can do them once you get good in an hour. The last thing here, lender authorization for major improvements. Now, this is just getting goofier and goofier as we go down the list. Why does the lender care? Let's just assume you're going to put your own cash into the property. You're going to replace the air conditioning unit because it's a little bit aged and you want a more efficient furnace and air conditioning. And maybe you don't use cash for those. Maybe you're planning on using cash, but the heating and air conditioning contractor says, hey, I got this cool 12 months same as cash financing arrangement. Would you rather use that same price? So sir, you sign up for that. And then everything else you're putting your own money into. You decide to tear off the back siding of the house and you're going to blow the property out a little bit larger in the back and build more rooms, etc. All of which, of course, is going to add value. And you're not borrowing money from any other lender other than for the air conditioning stuff. So why does your lender now care that you're going to undertake major improvements to an asset that is collateralizing a loan with them?
I would just have to assume that they want to make sure it's done in a proper manner so that you don't have any like shade tree mechanics going on.
That's one of the issues, right? Again, to the lender, they don't want to take a property back that's in poor repair. And if you start the remodeling, lose your job, break your arm in the process, whatever, cannot finish it, and the lender takes it back, they don't want to have finished property. They may want you to provide proof that you are hiring professional contractors or licensed contractors to do the work. They may want proof that you have a construction background, that you've done this kind of thing before. And in the case of the HVAC equipment, so you remember in chapter 10 we talked about various kinds of liens and we talked about mechanics liens. So what happens now? The contractor comes out and provides you new furnace, new air conditioner, new exhaust, maybe some new tie-ins, whatever. And in the middle of that, there's some dispute. Maybe you thought you were getting a 95% efficiency furnace and it's only 90%. And so you refuse to pay. And that contractor places a lien on those individual pieces of equipment that they sold you that you've not yet paid for. They might be able to repossess just that equipment, right? In which case you've got a property now without a furnace or without an air conditioner. And a lender who's saying, hang on, we have priority here. This is not like the time situation we talked about back in chapter 10. Let's assume this first mortgage loan's been in place for 4 years, way ahead of any mechanics lien claim that could possibly be there. The issue, though, is the lender has a security interest in the old furnace and in the old air conditioner, which are now where? In a dumpster somewhere, or at a recycling center, or going into a Habitat for Humanity project, not in the new stuff that's just gone in. So again, lenders have rights, they have interest in what's going on, and you may not know about it, but before you go and make whatever the loan documents or the lender or a court would consider to be a major improvement, you need to talk to your lender about it, to make sure they're aware of it, and they've signed off on it and blessed it and don't have a problem with it. What happens if you don't do this stuff right? You're in default. Now, it's easy to understand that if I don't make my loan payments, it's a financial default, right? If I fail to make my loan payments in a timely manner, I'm in default under the loan document. If I don't pay my taxes, if I don't provide proper insurance, if I start remodeling the house without their permission, anything other than being late or behind on payments that violates my obligation as a borrower under the loan documents is considered a technical default. Switching again over to commercial and industrial real estate, I managed a portfolio of properties for a while, all of which had, at one time, a deep-pocketed guarantor who died during the loan term on a number of these loans. And as it turned out, had been suffering financially for a number of years right before his death. And so when the lenders looked at the value of the estate compared to what they thought the borrower, or the guarantor rather, not the borrower, but the guarantor had, and this was right around 9/11 when commercial property values were declining and commerce had come screeching to a halt for that whole reason, because again, for a different reason, we thought the world was coming to an end. 3 properties of the portfolio I were managing under 3 different lenders were all put into technical default because the guarantor was no longer there to act as a guarantor. That was the issue of default. That was it. So the way to fix that was to provide a suitable guarantor. And in one case, one of the 3, the lender called the note. The note could be called every year on July 1st, and they called me on the phone on June 30th and said, "We're calling the note tomorrow." I said, "Thanks for the notice. I really appreciate it." This guarantor had been deceased for about 8 months at the time. I was not not directly involved in the ownership of that property at all, but I realized very quickly the only way to solve that was to become the substitute guarantor. So I got to pick up the phone and call my wife and say, "Guess what, honey? I'm going to take on hundreds of thousands of dollars of debt on a particular property that you've probably never seen and may never see, and we don't own. But don't worry, trust me, it'll be okay." And then we refinanced the deal, and that was the deal. The same owner, same corporate owner of the property, but different guarantor. And I charged that corporate owner a fee. Their board agreed to that. And about 1.5 years or 2 years later, we sold that property, and I got off my guarantee. The other 2 lenders, one let the property go for about 3 years before they forced it into a sale. And then another one, there was a couple years left on the balloon loan, and the lender never said anything, but they wouldn't refinance. They wouldn't even talk to us about refinancing on it. So we had to find a different lender. All right, so that's the idea under provisions for default. You can have financial default, that's most common, but any reason at all under the loan docs is still a default. We just call it a technical default in the biz. Acceleration, and the acceleration clause that's part of these documents, is a critical concept to understand. Without an acceleration provision in a mortgage, the lender would only be able to chase the part of the loan that was past due. So if somebody got 3 months behind on their loan and the lender wanted to collect the debt, all they could do is go to court and sue them for that 3 months in which they were arrears, not for the remaining 27 years on the note or whatever it might be. But when you add in this idea of acceleration, this is critical, right? Lenders have the right, when you're as a borrower in default, to accelerate the debt. Yes, you had 25 years remaining, or 18 years remaining, or 7 years remaining. But because you're in default, we're declaring all of that is due and payable today. It's accelerated from when it was due to right now. And the demand letter will be made by the lender indicating the default and all that sort of thing. So that's the idea of acceleration. Otherwise, it's very much like a lease, and you can only go and sue for whatever they owe you at that moment in time. So an acceleration clause will be in every set of loan documents, and again, it's critical there for the lender. You'll want to know what that is and how that works. All right. Mortgages and notes can both be assigned. You wouldn't assign just the note without the mortgage, and so they go hand in hand. That mortgage lien has to be released at some point in time. Borrower pays that thing off, right? It's paid in full either through refinancing or through a sale, or just because you've held it for 15 or 30 years or however long it took you to pay it off. That lien has to be released. Remember, we said in chapter 13, we never unrecord anything. So that mortgage lien stays in the public record. It stays there. So we have a lien and then a release, and then a lien and then a release, and then a lien and, oh, no release. That must be the current lien. So in Illinois, we get this single piece of paper usually, this satisfaction of mortgage document, that then just goes into the public record and is in effect recorded over the mortgage lien. It's more current. And you can tell that that previous lien was released. On residential loans in Illinois, that's got to be provided within 30 days of the time that the loan is paid in full. And if it is not, the lender is subject to a $200 fine. I have had several attorneys say, if you ever have a client that's in that situation, we'll gladly write the letter to their lender for free. Because you can't pay an attorney enough money and still get anything left out of the $200 otherwise. Right? It could cost you a half an hour of their time, there goes your $200. But attorneys, occasionally will get involved in something. Sure, we can write a letter, but you can also just call the lender. I know of several people who've gotten paid this $200 because the lender just slipped up, oops, missed, whatever, and it's no question, they just paid it. They realized it was their error, and they didn't want to have other problems. Lenders are very heavily regulated, and regulators do not take kindly to when lenders don't fulfill their obligation. Otherwise, every loan has a release document or satisfaction of document in any place in the country, again, recorded also. Sometimes there are a couple of pages. You should be able to get it all in one page in Illinois. All right, loans have escrow accounts, impound, reserve, trust accounts, whatever you want to call them. Some of you are probably escrowing for your mortgage payments now. Some of you are not. Some lenders do this, some do not. It varies by lender. But these things are all synonyms, basically, escrow, impound, reserve, and trust account. So you may have to reserve for property insurance and for real estate taxes. Those are the most common things. If the property is subject to flood insurance, then that also would be escrowed if you're escrowing anything else in there. So when we talk about the monthly payment of PITI, principal, interest, taxes, and insurance, you might be making that entire payment to the lender, because the lender is collecting enough across the year to cover your homeowner's insurance and or if you have it, flood insurance, and your real estate taxes when those come due twice a year. If not, if you're not escrowing for those things, then you as the borrower are obligated to pay those. So like on my office building, we have to escrow for taxes, but we do not escrow for insurance. Oh, we pay for insurance, about 20 grand a year or something. Taxes are 100 and something years. See, on my house, I don't escrow for anything. The lender I have in my house doesn't do that. It's not even an option. If I said to them, I'll pay you money to take it, no, we don't do that. Some lenders like the escrow account arrangement because it gives them cash on which they pay you no interest that they can use for whatever. Other lenders don't like the liability because now if they fail to pay your taxes or if they fail to pay your insurance in a timely manner and something happens, they're liable. It's their problem. So the lender has to know that they have the overhead and the management structure to be able to manage the money effectively, to make money on that money that's greater than the liability they take on by servicing those obligations. So again, if you're not sure what situation is going to be on a loan, ask the lender. I've seen lenders that will allow you to buy out of an escrow requirement by paying like a quarter point or something. It's up to the lender. Another common provision in mortgages is this assignment of rents. So we'll talk about this a little bit, and then after this we'll take a break. Lenders, I think we talked about this briefly before, but let me revisit this, please. Lenders look at 3 different tiers of risk when it comes to residential property. The ideal situation is a high down payment owner-occupant borrower. So there's the owner-occupant borrower, then there's the vacation or second home borrower, then there's the rental property borrower. When lenders look at these things, they will allow lower down payments and give you better interest rate if you're the homeowner occupant. That's part of their underwriting, part of their risk analysis. Because everybody needs a place to live. So the odds are you will do your best to keep that house. And if you have multiple properties and you can only afford to keep one, the one you're most likely to keep is the one you are living in, and you let the other ones go. So if it's going to turn into a rental property, or rather if it is a rental property, higher risk, because the lender realizes you can just let that go whenever it suits you, if that's your financial situation. So in some cases, the lenders require borrowers, particularly on homeowner-occupant type loans, to sign an occupancy statement. I swear I'll live in this house for, you know, the next 6 months or a year, or whatever the minimum occupancy requirement is. I think with HUD it's a year, maybe, something like that. Other loans may have different periods. Some may say this loan is valid so long as, you know, as the borrower occupies the property. Meaning, you know, if you were to leave, you're supposed to pay off the loan and refinance it. If I have a house, well, I do have a house today. So if I decide I'm going to keep my house with my homeowner occupant loan and risk and interest rate and that sort of thing, how difficult is it for me to turn my principal residence into a rental property? What do I need to do to make that happen? Move out and rent it to somebody. That's it. Now the lender's taking more risk than they originally contemplated, and they don't know it. So one thing they look for to be able to cover themselves in that is this idea of an assignment of rents clause. The absolute screaming worst place to be for a lender is the borrower is in default on the loan and not making any payments at all, yet there's a tenant in the property who's paying rent to that same borrower. That drives lenders crazy. Because now you're making money on their money and they can't even get paid back. So lenders want the right to attach those rents. That's what an assignment of rents clause does in a mortgage loan. Whatever rents are being received, so long as you're in arrears on a borrower, are due and payable in full to the lender until such time as you are caught up. You can guarantee that's front and center in any loan in which there's no occupancy statement or occupancy requirement. But it's probably also in every loan in which the borrower might end up leaving and turning it into a rental property, such as any single family house or townhouse or condo or whatever. So again, I think you'll find that's a fairly common thing, and hopefully speaks to the idea of what the risks are for lenders for something as simple as you just buying a house that you're going to live in or occupy. You can buy a house today for 5% down, so you buy it for 5% down, you sign an occupancy statement, and 12 months later you realize, hey, I can get enough rent for this house to be able to cover the principal, interest, taxes, insurance, and my PMI for putting a loan money down. I think I've got 5% saved up for another property. I think I'll turn this one into a rental, and I'll use my 5% down and go buy another place. You could do that every year if you only have to occupy houses for a year with that particular lender. Great way to acquire property and make money on the appreciation without having had to put up much cash. All right, so let's go ahead and take a break. Let's come back at about, we'll say 5 till, that's about 12 or 13 minutes. Then we'll pick up and continue on with this if everybody's back by then.